So we're almost done with bonds. This is our second to last video. We're going to talk about credit agencies and credit ratings, which affect the value of those bonds. Higher risk bonds have to yield a higher interest rate in order for it to attract an investor to lay their money down and to partake of those bonds. Let's talk about some of the quality of debt and some of the credit rating agencies that determine that quality and see what the repayment looks like. So looking at credit risk, this is the risk that an investor will not recoup the amount loaned or the interest. So I give you my money, I expect payments of interest every 6 months, and I expect the principal back at the end of the bond term, the end of the loan term. But the company may be in dire straits, or they may be challenged or have problems, or potential in an industry that might be having problems. So we evaluate the quality of that debt. Borrowers with higher credit risk have a lower quality of debt, and that quality is important on determining interest rates. The key here is, can the company pay back not only the interest, but the principal at the end of it all? And there are two areas, two factors that we dive into. One is level of indebtedness, and the other is if there's excess cash to pay the interest and ultimately the principal. Let's talk about level of indebtedness. So if I have 95% debt and 5% equity on my balance sheet, I'm a pretty high risk company. I might have one bad year, I've got negative equity, I now have liabilities exceeding assets. That's upside down, that's bankruptcy territory. That's not a good thing. However, if I'm at 10% debt or 50%, I've got a whole bunch of debt capacity. I can lose a whole bunch of money, and my equity holders are going to take the hit, not my debt holders. So we have a term excess cash here that means the cash the company is able to generate over and above what it needs for operations and investing in the normal course of business. Let's take a look at the market rate of interest. Lenders acquire a higher interest rate as credit risk increases. High risk, higher rate. That sounds logical. So the market rate is made up of two things: the risk-free rate, which is typically associated with the government rate. The risk of default of the US government is pretty low. Now, I'm not going to talk about the city of Chicago or a bunch of other cities out there that have higher risk of default, and they have pension obligations, and they can't collect all the taxes they really need, and they drive people away. But the risk-free rate is the government rate typically. And then there's the risk premium. And this is more of a finance term, but this is what you pay above and beyond the risk-free rate. And you need a higher risk premium for higher risk investments, a higher level of credit risk, higher level of premium. So let's take a look. We've got some bond ratings. And this is a AAA, AAA. That's the highest rating for most of the companies. And then we have a BAA. Well, the risk-free rate, the treasury rate, was all under 3%, except for a brief spell in 18. Then it went back down in 19, under 3%. We look at 4% more of the average for AAA ratings, and we're looking at more closer to 5% for our BAA. So that is the yield that an investor would expect based on their investment on the different ratings that a rating agency would share. So three major agencies, we're looking at S&P, Standard & Poor's, we're looking at Moody's, Investor Service, and Fitch. Moody's is actually, in the bond arena, Moody's is pretty well known. Standard & Poor's, you've probably heard of, the S&P 500. They do a lot of other evaluations as well on stocks and equities and debt. Fitch is often in the insurance industry too, as kind of a measure of risk. But we're looking at credit risk here, and look at the A's. The AAA or the Moody's is a little funkier. A, uppercase A to lowercase a, AAA. And you go down to the A plus, medium grade, upper middle, upper medium, lower medium, B's, BAA, BBB plus, non-investment grade or speculative. Now, under that green dotted line, you might have heard the term junk bonds. And those are bonds that you may expect not to really be able to collect at the maturity. These are much higher risk bonds. They might be either bankruptcy or they might have to refinance or somehow end up paying higher rates. And a lot of folks don't have confidence in their ability to pay the interest and the maturity premium, the maturity value when the bond is done. So you look at that and say, would I be willing to invest in a junk bond? We'll talk a little bit more about that later, but the answer is it depends. And we'll see what it depends on in a few minutes. Here's our credit rating agency, two-step approach. We first assess the likelihood of default, meaning I'm not going to pay the interest or I'm not going to be able to pay the maturity value when the bond term ends. And you gauge that basically historical and forecasted level of debt and the excess cash flow. You look at those two criteria before. The second step is assess the potential loss that the lender will suffer in the event of default. So if they default, what's the downside? Do they have the collateralized loan? Are they mortgage-backed securities that are backed by houses or buildings or equipment? And what are the other loan terms and covenants? There are other things that will often be said in a loan term that may give it extra value and reduce interest rates or increase interest rates. I'm not going to go into a lot of details here, but here's one sample rating system for Standard & Poor's. And they look at country risk, industry risk, competitive position. And those are all things that will affect the risk that the investor will incur when they make an investment. A diversified portfolio, financial policy, capital structure, liquidity, management and governance. They just get a new CEO or on their third CEO in 2 years. They're going to be making evaluations and ultimately do a credit rating when all is said and done. So here's an example of Standard & Poor's issues credit rating. Business risk strong, very low country risk, mostly US and Europe. Industry risk intermediate, competitive position strong. Okay, so they're in a pretty good position. Ultimately, they're BBB+. That's what was assigned to Verizon here. And then we look, expectation will continue in the future, the direction, what's going on, what's the cash flow looks like, adjustments for earning before interest, tax, depreciation, amortization, EBITDA, which is a mouthful. And then we go looking and say, oh, we've got credit ratings, partial illustrator ratio used by Moody's as opposed to Standard & Poor's. And they're just different ratings from AAA down to CAAC, different ratings. The last slide, I want to talk about junk bonds again and look at that last slide. This is saying 5-year default rate. So chances in 5-year with the trading at CAA3, that's a 49% default rate. Probably close to 50% of these bonds are going to default, and close to 50% won't. So would you ever invest in a bond that has a 50% chance of not seeing the light of day and paying back what's owed on it? And many of you might say, no, why would I do that? They're saying, well, there might be a case. I can make a case for that, and I will. If you have a 50% chance of default, and you have it all depends on your purchase price. You have a chance to buy that bond at 10 cents on the dollar through junk bond status. Well, if I buy for 10 cents on the dollar and I buy a bunch of other bonds at 10%, 10 cents on the dollar, 10 cents on the dollar, if half of those actually pay off, I'm going to make 50% back. On 50% of those bonds, I'm going to get all my money back. And 50% I won't. So I'll throw those away and I'll make the money on the ones that I did. 65% sounds even worse. Maybe I'm paying 5% on the dollar. Or you get down to that AAA, 0 defaults, down to the BAA, BA1, BA2, 0 defaults. You start getting up to B1, B2, B3, you're close to 10%, up to 20% defaults. And then the C starts at 21%, up to 65%. So there is a place in every investor's portfolio if they choose to take some high risk investments and some low risk. The high risk have potential for high payoffs. And the low risk, slow and steady, but the interest rates are going to be a lot less. That's why junk bonds usually pay much, much higher interest rates. We're going to take our next set of slides, a deeper dive into the time value of money. We talk annuities and annuities due, future values and present values. The focus is on present values and annuities. Those two categories are going to determine bond values for us. We've already seen how a $10 million bond could be worth 8.4 million, could be worth 11.2 million. It could be worth 10 million. Depends on the market rate of interest versus the stated rate of interest. And we will talk on how to calculate that time value of money. Most people just punch in a calculator or even Excel template and Excel spreadsheet these days. We'll go through the tables, and by learning the tables, it'll reflect. It's an easier way to see and understand when we're talking about time value of money. Thank you for your indulgence. Glad you're still here. Forward to our next video.